Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to subscribe for the latest updates. Now today, as monetary policies fluctuate and commodities sway in the balance, we'll reveal what's brewing behind the scenes and how it could impact your investments. We'll zero in on the Fed's latest moves compared to the rate cuts around the world, what's on the horizon for the U.S. economy, and as tensions rise in the commodity markets, from silver prices testing that $30 mark to China's grip on essential minerals. What key shifts should we be watching out for? Well, joining us today to break it all down is John Feneck. He's a commodities analyst and the CEO of Feneck Consulting. John, thanks for coming on the show and making time for us today.
Of course, Jeremy. Thanks for having me.
Let's jump right into this. I mean, we got lots to get to, but I guess we'll turn to Canada and the ECB, the European Central Bank. They both cut some rates last week. Not a lot, but while the Fed remains quite hawkish after their FOMC meeting this week, they need to see a little bit more positive data, Jay Powell said, to lower interest rates. Talk to me. What do you see as a path for the U.S. interest rates in the coming months, and how is it going to affect the equity markets?
Sure. So Powell was hawkish in his June 12th meeting. I thought that it was interesting. He kind of put all his chips in, right? The headline on CNBC and Bloomberg was one rate cut for all of 2024. That's what printed right after the announcement. And so that's really putting the Fed in a corner, in my opinion, because if you look at the world and how things have shaped up here just recently with the Russia, currency news today, with Trump talking about an all tariffs policy here literally within 24 hours ago, we're seeing a world that you could have a black swan event at any time. If you look at gold's ascent here, it hasn't had anything to do with a black swan event in actuality yet. So to answer your question about the direction of the Fed, it's a difficult one, but let's just say that the July 31st meeting has an 8% probability of a cut, so that's off the table. September 18th was about a 45% probability, the last I looked a day ago, of that 25 basis point cut that the Fed is talking about. But what if we don't get that September 18th cut? And that's what we've been writing about in our newsletter and talking to clients about, is that the equity markets are not going to like that, right? And so I think you could see a tumultuous period of time, say mid-September through the election in the U.S., where the market, meaning the S&P and NASDAQ, the broad market, might correct.
Okay, let's talk about the correction. If you're seeing a correction on the equity side of things, how much of it is going to be political going into the elections this year? And what can the Fed kind of do to moderate a little bit of this negative notion towards the markets here? I mean, we started talking about 6 or 7 markets. We're used to the market forefront and front running these price cuts. Now, as you mentioned, maybe about 1. Talk to me about the hypotheticals here.
Okay. So remember that in 2020, the Fed cut rates by 100 basis points on a Sunday. So the Fed has extreme power. That's why we look at the Fed first in everything that we do. And I wouldn't be surprised to see them walk back this talk of one rate cut here if something happens that we can't foresee, right? So they have this ammunition, if you will, and that would be extremely bullish for precious metals and miners. So we think that they're really painting themselves into a corner here. I mean, the scenario that I see is a correction between, say, that Fed meeting September 18th and the end of the year, or even November, because we are at all-time highs, Jeremy, right, in the broad market. I mean, this rally started in March of 2009 with a few pullbacks. So, I mean, we've never seen anything like this where you have 15 plus years of this kind of run in the broad market. And that's why we're encouraged by gold's breakout, silver's confirmation of that breakout just recently, because now we're in a position in this mining sector that we haven't been in before, which is we're now seen as a safer haven. And that's really, really bullish, because if we do get a correction, I'm not in the camp like so many investors that sees, the mining stocks get creamed, gold gets creamed. I think it's going to be maybe a knee-jerk reaction down, followed by a really nice rally, because we're going to be seen as something that's a place that, investors can put money, PMs can put money, that isn't going to be, it's going to zig when the market zags.
Yeah, interesting take on the mining side too. Let's switch over to commodities a little bit here, John. Morgan Stanley recently issued a report on China's dominance in certain commodities, many of which are on the U.S. critical minerals list. Why is this dominance important, and where do you see things, going with respect to the U.S. being able to catch up in this commodities race?
Yeah. I don't think the U.S. is doing a very good job of catching up at all. However, I was in D.C. for a conference in the mining space 6 weeks ago, and the vibe that I got from CEOs that were meeting with politicians was very, very positive, much more positive than in previous years. So the U.S. is starting to come around to the realization that they have to do something more. I'll give you an example, like in tungsten, right? This is on the critical minerals list. It's a metal that's used in armor and defense. It's important, right? China literally produces 91% of this metal. Last year in 2023, the U.S. produced 0% of the world's tungsten production. So, where is this going to come from? There's literally only a couple of stocks you can look at. In our purview, it's going to be Golden Metal Resources, GMTLF, and Fireweed, which is FWEDF. Both of these companies are positioned to get DoD money, in my opinion, because they're so unique. There's only a couple of North American tungsten, companies out there, and Fireweed's in Canada, and Golden Metal is in Nevada. So great jurisdictions. I think the U.S. is coming around to the idea that they have to support companies like this in order to, fight this dominance that China has.
Yeah, talk to me a little bit more about these equities that you're seeing that have some potential upside with partnering with governments, understanding that we need these critical minerals. Talk to me about if there's any equities that you're watching over there.
Sure. So in addition to the Morgan Stanley article that you mentioned, that was April. That really got my attention because Morgan is the largest broker-dealer globally, just for people that don't know. For them to write an article about small little juniors like Perpetua, PPTA, and some others that I saw was pretty amazing. But there was also a piece that came out just a few weeks ago from the U.S. government, basically placing tariffs on China for certain commodities, raising those tariffs, if you will, from 0 to 25% in some cases. Some of those metals include manganese, tungsten, which we mentioned, zinc, et cetera. So when you look at equities, you want to find companies that are going to have some type of leg up on the competition. For us, Aftermath Silver, while it has silver in the name, is also now a manganese company, because in February they came out with news that they have 99.9% battery grade manganese, right? So that's what you need in order to get people's attention. That doesn't mean that the stock flies immediately. It did move a little bit on the news, but AAGFF is one of those stocks that we continue to buy on dips, because we realize now that they have something that they didn't have just prior to this year, and that's really going to position them to diversify their potential revenue stream down the road. So we're constantly looking for unique situations like that are going to be relevant as we move forward to the U.S. government.
Interesting. Okay, so tungsten, manganese. Let's talk about gold. I mean, gold price is currently hovering around that $2,300 mark. How do you see the market developing in the next few months here? We've had a small pullback, but still a big demand out there.
Absolutely. A lot of that demand has been driven by central bank buying. We saw just last Friday kind of a double whammy in the mining sector, where China did not increase purchases for the first time in 18 straight months. So that was part of the sell-off that I think contributed June 7th, but also non-farm payrolls, right? The headline number came in about 100,000 jobs hot. No one's going to like that in the mining space. I think this is just temporary in terms of the gold rally that we're seeing is real, right? I mean, if you look at the breakout that we saw earlier this year, to get through that 2060 to 2100 level was really bullish, and it did it with authority. Ran to 2400 plus. Now we're at 2300 as we record or so. It's going to really matter for earnings, Jeremy. Okay, if you look at Newmont's earnings, if you look at Agnico's earnings, these are two of the three largest holdings in GDX, which is the largest mining ETF out there, right? It's a $15 billion product. So go look at NEM or AEM and look at their earnings in January and look at their earnings in April, and they're improving. They're going to improve a lot more at 2,300 gold, right? Because these, as we teach clients, you want to have part of your portfolio in producing companies like this that will realize the gains from gold's ascent, right? Because if you're a gold explorer, you're not producing anything right now, right? So you have to be cognizant of that. So we think Newmont, here flirting with breaking $40 is just a screaming buy. Dakota Gold, DC, is based in South Dakota on private land. Bob Quartermain is the chairman there, has tremendous success in the mining business. He and the CEO, Jonathan Odd, own 15% of the float. The float's only 100 million shares. So, a very tight share structure there. Those are the kind of things that we look for, good listings on the New York Stock Exchange, both of those companies, but, are really beaten down on the chart.
Yeah, no, you mentioned Bob Quartermain. We had him here on the show not too long ago. Big fan of what he does over there. Talk to me a little bit about the junior side. It's been an interesting year and kind of tough. We can't really get the retail market to come and invest quite yet, but we also have to look at management. It's been an interesting perspective for them having to raise capital in such a terrible market, often diluting a lot of these small caps. Where is some potential here?
It's a great point. Junior mining is always going to require funding, right? And I applaud the CEOs that are finding creative ways to get funding for their projects. One that comes to mind is First Tellurium, FSTTF. This company literally a week ago said that they attracted $29 million US, 40 million Canadian, from an entity for part of a subdivision of their company that people weren't even expecting, right? This is a very small market cap company, in full disclosure. But when you attract $29 million US and your market cap is a fifth of that, that's telling you something, that analysts are going to start looking at that company. Bankers are going to start looking to support that company, and that helps them fund things going forward, right? So you look for news items like that. And I also feel that the market is improving for certain commodities in terms of financings. And by that, we saw uranium really get a lot of funding last year that carried into this year. If you look at gold and silver, some of those names are actually doing quite well now on the financing side. It's going to take a little bit more for some of the PGMs and nickel and certain commodities to really attract that kind of money, I think. But I think we're headed in the right direction. I agree with you that 2023 was a very difficult year, but this year seems to be better.
Yeah, a lot of people happy to hear that one. Hopefully next year, too, when it comes to capital raising, cost of capital at least down. Let's switch over to copper. Prices on that side have been strong. There's been some short squeezes pushing prices higher. How do you view the outlook for copper and other industrial metals like nickel here in terms of supply chains and what we're seeing for demand?
Yeah, sure. So we spoke at the Energy Transition Conference at Beaver Creek on day one last year. It was me and Michael Connard from Vizsla Silver talking about different commodities like copper. And, I said to people that Goldman Sachs literally last summer said, we see 15,000 plus on a metric ton basis by the end of 2025. And so at that presentation, I think copper was under 8,000 a metric ton. So I said, that implies about a 90% move in copper, not copper stocks, which have tremendous leverage to that move. So we started to buy copper and copper stocks heavily last year. We don't tell people stuff that we don't back up with our own money. So we think that copper juniors and developers here look very, very, very attractive. We think the large caps have made a move, but they're not done making a move. If you look at COPX, that is sort of the large cap ETF that investors can look at, that is similar to GDX in terms of the larger cap nature of the product. So we own a little bit of that, but we spend most of our time looking at copper juniors that most people haven't heard of before, because there's going to be tremendous upside there in the coming years. Or companies that have pivoted away from a situation that can't help them currently, right? Like Vortex Metals, to me, VMSSF, it's a very small stock. They basically have a geo that's been a BHP guy for 16 years. And so you look at stuff like that and say, why would John Larson attach himself to a project like this? Well, it's because, in Mexico, where they have their two main projects, there's been obvious strife with AMLO and the election, right? So they're not sitting there on their hands. In other words, they're pivoting to Chile and saying, okay, we're going to set up right next to a producing company in a good jurisdiction where they can get permitting and get going on things. And that's what you need to look for as an investor, is a company that's going to not sit around and feel sorry for themselves. They're going to actually do something about, what the environment is giving them. You have to deal with the hand you're dealt.
Yeah, you've got to be able to pivot. I mean, that brings us to, the investment opportunities on the industrial metals side, because, as we know, commodities are very cyclical. We've definitely seen lithium prices go from A to point B. We've seen this on the copper side too. It's not just trends. Even when some of these junior miners pivot and decide that they have a different story or a different asset here, where's the biggest potential? I mean, it's just it seems like put some blinders on a longer term picture here. And, how do we cut through the noise?
Yeah, it's a great question. I mean, if it's not me, you need to call someone in this space that cares and align yourself with them as an investment professional that can give you some guidance. That's my first suggestion. And I don't do something like I'm doing that with my own, time. I'm going to CEOs where I don't know the story well enough, and I'm spending that time to pass that on to my subscribers to say, look, I just talked to the CEO. Here's some clarity on this press release, because some of these press releases, as you know, Jeremy, get really in the weeds. And the average person is just like, is that good news? I don't even know. I mean, you have to be able to articulate your story. That's something that I coach CEOs on. If you're a geologist by trade, that's cool. I mean, you have to hire someone on your team that understands how to communicate your story through the presentation deck, through a fact sheet, when you present at conferences, et cetera, because otherwise your message is lost. And so I think there's, a lot of disconnect in this sector, which creates opportunity, right? You have to be able to pick up the phone or align yourself with someone like me who is picking up the phone. I talked to 12 CEOs this week, trying to get a finger on the pulse of what is actually happening behind the scenes with that company. What does their cash balance look like? Do they carry any debt? What kind of a warrant overhang do they have on the stock, et cetera?
Yeah, John, I picked an interesting time to come back into journalism from the finance side. We got elections, as I said, in a lot of different nations going on. Certainly, the U.S. economy has been crazy with some of the data that we've been seeing, as well as contradictory data. Talk to me a little bit about the macro here. I mean, what are the key risks and opportunities for investors, and what should they be watching for this year? I mean, how do they position themselves to take advantage of what we just talked about?
Sure. So again, going back to this notion that I had about the markets just running real hot here, it's been a 15.5-year rally. If I were an investor listening to this, I would take a strong look at my 401k, where my real money is, look at like what you paid for your house and what it's worth today, and say, man, I need to start taking some risk off the table here, right? Like I again, don't do things, without taking action myself. I sold 4 my houses, in the last 2 years for a reason, because I don't want to be that guy that's up against my neighbors trying to sell my house in a market that's declining. I think the higher interest rates for longer that we just heard from the Fed literally 48 hours ago are going to put pressure on the housing market. And the housing market has been driving the stock market higher, in my opinion. They're connected. So if you get higher rates for longer in the U.S., you need to be thinking about this kind of stuff, right? And be thankful for what you've already made in the broad market, and take some off the table, put it into things like gold and silver that are tangible assets that have been around forever, right? Or put it into a sector like mining that gets no credit from the street, right? Like, I mean, we're so under-owned right now in this sector. As we sit here today with gold at 2,300, it's maddening.
Yeah, absolutely. And I mean, it's under-owned as well because the performance has not been that good. There's certainly been some divergence from the metal prices. Is it just more of a longer-term play here? What do you say to retail investors that are used to grabbing 20, 30% on the equity market on the S&P side? Looking right now is the time to position into some of this more longer-term tangible assets?
Yeah, absolutely. You make a great point. I mean, if you look at GDX or GDXJ on a 5 or 10 year chart, it's pretty darn ugly. It's not something that you can buy and hold, in other words. And that's, I think we're getting to a point where you could buy GDX or GDXJ here with metals prices doing so well and hold it for 3 years, right? But if we were to have this conversation 2 or 3 years ago, I would not be saying that. I would say, and I have said on Kitco, that you need to be on top of this literally every month and trade. Now we're looking at this as much more of a longer term hold, our sector. But you have to use a rifle approach. You have to call the CEOs. You have to talk to management. Management is absolutely our first screen. The project itself being a very, very close second.
Yeah, and don't forget to take some profits from time to time. I always tell people too. Hey, John Feneck from Feneck Consulting joining us today. Hey, thanks for coming on the show and breaking this all down for us, my friend.
Of course. Thank you.
Thanks, John. I'm Jeremy Szafron for all of us at Kitco News. Thank you for watching. Stay tuned for some more great content coming your way. Don't forget to hit that subscribe button and even leave a comment telling me on who you'd like to see on the show next time. We'll see you.